Well, I have to say, I won't be drinking very much Diet Pepsi in the future either. Thanks to Adele. I don't know if she heard that. Yes. No more Diet Pepsi. Yes, yes. I'm going to try. So this presentation is called The Art of Leaving a Will. I'm actually not going to talk about the procedure of putting together a will because most of you here, if not everybody, is a client of TE Wealth, and I'm assuming that you're either in the process of putting your wills and powers of attorney together or you've actually had them done already because that's what we do at TE Wealth. Well, that's one of the things that we do. So I'm not going to bore you with the small details. There are just a few things that I wanted to bring up, things that might be new to you. If they're not new to you, they might be new to a family member, might be pertinent to a family member, maybe children, for example, because they're at a different stage of their life. So I thought that I would talk about the following things. I'm going to talk about some things to consider when you're appointing an executor of your will. And I think I have to go like this. Yes. And oh, by the way, sorry, everybody should have a copy of the presentation. Okay, just want to make sure. So I'm going to talk a bit about things you should consider about your executor when you're putting together your will. I'm also going to talk about what I call the administration of personal accounts, having to do with the internet now and what needs to be done in that area. I'm also going to talk a bit about the benefits of a testamentary trust. Also the issue of joint ownership, that's coming up more and more. And I'll talk about beneficiary designations. And then I'm just going to touch briefly on impending changes to legislation because there are a couple that they're probably going to happen at the end of the day. It's probably just a matter of time. So over the years, I've met a number of people. They're usually younger. They could be newly married, even with children, but they don't necessarily have any assets, or if they do, maybe they have a tax-free savings account or an RSP. They're already beneficiary designated. Maybe all of their accounts are in joint name, and they say to me, well, let's say they don't have children. They'll say to me, you know what? Why do I need a will? There's no reason. Everything's going to be taken care of just because of the way things have been set up. And I say, well, you know what? You still need a will because you still need somebody to help out with your estate after you're gone. Because even if you do have, for example, let's say you have RSPs and they have beneficiary designations, I can tell you from experience that changing over the beneficiary designation doesn't get done by itself. And if you happen to be a surviving spouse who still has to work full-time, maybe you have a small child that you have to take care of, the last thing you're going to have time to do is to go to the bank, make appointments with people, take care of stuff like that. And in this day and age, it's very difficult to get, especially financial institutions will not talk to somebody besides a surviving spouse about making changes to accounts. You can't call up and say, well, I'm a relative, I'd like to take care of this. They want the spouse, but better yet, they want an executor of the estate. A lot of the time, they would want a probated will, but if there's no will, then they really don't have a choice. Then they're going to insist on meeting with the surviving spouse, and that can be a very difficult thing to do when you don't have the time. So it's things like that, but also even small things like having to cancel cell phones, for example, maybe taking a name off a phone account, canceling credit cards. If you're alone and your spouse has just passed away, the last thing you're going to want to do is to have to take care of something like that. You're not going to be in the mindset. You're not going to have the time. So it's much better even just to put together a very simple will that at least states an executor, so you won't have to worry about those types of things afterwards. And then related to that, I have your being an executor can be a very big job. So you might want to even, in your will, depending on the size of your estate, you might want to appoint more than one person as an executor of your estate. You know your estate best, so that's one reason why you might want to appoint more than one person as the executor. Another thing, and actually I was just talking to somebody about this before we started, you do want to make sure to review your will on a regular basis, especially if your executor is not able to act anymore. Maybe they've moved out of the country, maybe they've become incapacitated. There's numerous reasons why they may not be able to act. If you've only put one executor in your will, you're definitely going to need to make a change there. If there's no contingent, could be that the executor originally told you they would do it, then they did it for somebody else. They realize it's too much of a job for them. They've decided they don't want to do it anymore, and they tell you that. You might have to make a change for that. Or it's possible that somebody who you've designated as a beneficiary passes away. Now, sometimes your will take care of that already, and there will be contingencies in your will, but sometimes there won't. So just whenever something happens, whether it's a life cycle change or if somebody passes away, it's always a good idea to go back to both your will and your powers of attorney just to make sure that going forward everything will work the way that you want it to. Oh wait, that didn't go. Okay. Another thing to think about, this doesn't happen as often, but it can. When you're appointing an executor for your will, it's not a good idea to choose somebody who lives outside of the Commonwealth, because if you do, when you pass away, they are going to have to post a bond, and this bond is double the value of the probatable estate. So it's a real hardship for the person. They're also going to be very far away. They're not going to be able to take care of your estate. So it's a good idea to keep that in mind when you're appointing an executor. And also, if you're going to only appoint one executor, I wouldn't appoint somebody who actually lives outside of the province because of the distance. It's easier now than it used to be, but still between distance and possible time changes, depending on where they are, it's probably just going to be too difficult for them to do that. So that's something to think about also. Sorry about that.
Marcy,
Oh. Thank you. No, it's... Oh. Okay, now we've gone too far. Wait, there we go. There we go. Is that okay? Okay. Or sorry, oh, yes, that's better. Okay. So once you've put together your will and powers of attorney, it's very important to get all of your documents organized for your executor because eventually they are going to need them. Your executor needs to know, for example, the location of birth certificate, marriage certificate. For example, they will need a marriage certificate if they're going to help your surviving spouse to apply for the CPP survivor benefit. I would recommend that everybody who's married go home tonight and look for your marriage certificate, because I know people who have told me they've had experiences where either theirs was wrong or they never got one, and then you have to apply for a new one. The process it's not horrible, but once again, it's the last thing you want to have to do right after your spouse has passed away. So I would recommend that people go home tonight, look for these documents, make sure that you have them, and, sorry. Okay, that one I don't know how to get rid of, which I touched by accident. Megan, sorry. I'm going to keep my hands. I'm going to stop talking with my hands, I think. That's the problem.
It's okay.
Okay, thank you. Thanks. So yes, things like birth certificate, marriage certificate, any key documents. If you have proof of, for example, U.S. citizenship, you might need that. Anything like that, I would put together in a folder or in a binder. Also, tax documents, very important. And financial statements, RSPs, investments, anything like that, you want to put together either in a binder or a folder. Let your executor know where it's being kept. maybe keep a copy with your will. It's up to you, whatever you're most comfortable with, but it's very important to have a good record of the location of the documents. And I think, Megan, you had said that we've got some, is it binders in the back for afterwards, or some handouts about that also for people to pick up that you'll find very helpful. Okay, then what I call the administration of personal accounts. And these are mainly accounts, first accounts that are on the internet. Because now in the new information age that we live in, people have email, people have PayPal accounts, people have social media accounts, and I've only listed Facebook, Twitter, and Instagram here. Those are the ones that I know of. I'm sure there's a lot more. And people don't know when a person passes away, if you want to close down any of these types of accounts, what needs to be done. And each one is different. I can tell you just from being on the internet for a bit, with Facebook, they do give you an option of either having a tribute page to the person or closing it down. It's your choice. But the only way to find out for sure what can be done is by usually going on the website of these types of media accounts and looking to see what can be done. There's a good chance you're going to need a copy of a death certificate a lot of the time to make changes. But I think it's a good idea to find out what needs to be done and to do it. The last thing you want to have happen, I know somebody who had a family member pass away. They had a page or on Facebook, and somebody didn't know they had passed away, wished them happy birthday on their birthday. Other people saw it, and you don't want something like that to happen. So I know it's not top of mind, but eventually I think it's something that you'd want to do. The other one now that a lot of people have are cards for loyalty programs. So we have Air Miles, we have Aeroplan, and these are just a few from a long list, I'm sure. There's the Shoppers Drug Mart Optimum points, you've got HBC points, you've got President's Choice points. The list is endless. And once again, depending on the program, there are different rules for what can be done when the person who's got the account with the points. Some companies will let you transfer ownership. Once again, it depends on the company. So you have to either check their website or call them up to find out what can be done. Sometimes people accumulate quite a lot of points that are actually worth something. So it is worth it to look into this. Also, it's something to consider when you're doing your will, if these need to be included in your will or not, or if they're just, I should say, included separately in your will, or if they're actually already included as the residue. Another thing I wanted to talk about a bit are the benefits of a testamentary trust. In case you don't know what a testamentary trust is, it's a trust that is set up upon the death of a person. This only happens if there's a clause in a will that states that the person's assets be transferred into this testamentary trust. And one of the big benefits of having a testamentary trust right now is the tax savings. So what would normally happen if there was no trust is that the surviving spouse would receive the assets of the person who died, and any income that was earned on that asset would be added to their own income, and they would pay tax at whatever their regular marginal tax rate is. So for example, if somebody's making $200,000 and then they inherited an estate from their spouse that added another $100,000 of income during the year, they could end up paying a lot of tax. Whereas if they have a clause in their will that says that they can instead, if they choose to, if it makes sense at the time, to have their assets go into a trust, that trust is considered an individual, a completely separate individual, and any income earned in the trust is taxed like an individual. The calculation goes through all of the tax brackets again, so there can be a very big tax savings, and this will happen every year that the trust is in existence. So it's not a one-time thing. It's for as long as the trust is in existence, so there can be a very big tax savings at that time. Another benefit of setting up a testamentary trust is creditor protection. And basically, if the beneficiary goes bankrupt, a creditor cannot get their hands on those assets if they've been put in trust instead of being given to the beneficiary outright. So that's excellent protection. There's also protection in the event of a marriage breakdown. So the assets of the trust will not be included in the calculation of net family property. The ex cannot get their hands on the money, which is usually a good thing. And lastly, it also can protect against a spendthrift beneficiary spending all of their inheritance at once. So if an individual knows that they have a child who's not so good with money, and if they know that if the child received a large inheritance, they would go out and spend it the next day or the next few days, they can instead choose to put the money in trust for the beneficiary. There would be a trustee who could control the payouts, and the money would last a lot longer. Another thing that I'm sure you've seen, that's people have been doing more and more, either to save on probate fees or just to make life easier for them as perhaps they get older or they're out of town a lot, is a lot of people are now adding somebody else as a joint owner to their accounts. A lot of people are doing it to avoid what we now call the estate administration tax, what you might know as probate fees. Some people don't realize that when this is done, when a name of a relative, for example, is added to an account that is not a registered account, there can be income tax consequences, but this depends on whether there has been a change in beneficial ownership. That's the main player there. So if there is a change in beneficial ownership, then there will be no estate administration tax or probate fees, but there will be a deemed disposition on half of the whatever is in the account. So for example, if somebody has an investment account, they put their child down as a joint owner, and there is the intention that the child will benefit from the assets in that account, then it's as if they sold half of that account to the child, and if there's any gain on those assets at that specific time of transfer, then the person who did the transfer is going to have to pay tax on their tax return right there and then. So that's if there is a change in beneficial ownership. If there is no change, so let's say, for example, a lot of people will add somebody else's name to an account if they travel a lot, if they want to make sure that there's easy access to their account for somebody else if they need money, or if they just want to make sure, let's say, for example, that after they die, right in the beginning, that there is an account that somebody can easily get money out of without having to go through a probate process. Then there's really no change in beneficial ownership. They still control that money. In that case, there actually, even though there will be two names on the account, there will be an estate administration tax. And a lot of people don't realize that. However, the deemed disposition will not occur. So it's one or the other. Either you're going to pay the probate fee or the deemed disposition tax. So depending on the situation, you have to think about that before you make that change.
That includes spouses, or you use the child example?
A spouse, you have a choice with what you want to do. There isn't usually, though. Are you talking about the deemed disposition, or?
You, on the joint ownership of an account, for example, you use the example of children.
Yes.
Does it also apply to the spouse?
So with spouses, there are more tax rules involved. You can transfer things at cost if you want to, so it's a little bit more complicated. It won't always happen with the spouse. Depends on what you want to do. We can talk about that afterwards. I think I'll go into a bit more detail. Not that I don't want anybody else to know, but it's a bit more complicated to discuss in this forum right now. think I saw another hand. Did I? Okay. Yep. So, Robert, that's a very good question. Robert is an employee of TE. I would call this a gray area. Because at TE we do everything above board. I'm giving you this information, but if we're talking technically, the only way that CRA is going to know about a change in ownership is if a social insurance number is added to the account. Or taken away for that matter, or changed completely. The Ontario, I'm just thinking the Ontario Ministry, I think is it the Finance, although, and I'm going to touch on this at the end, although they probably don't have a very good way of figuring out what's happened, there is. Oh, you're taking me to the end of the presentation here. They are starting to crack down more on finding out about assets for probate. So I think there's a good chance that they're gonna find ways to find out about stuff like us. Yes. And also, the last thing you want is to be, just in general, you might know this already, the last thing you want is to be caught by CRA doing something that's not above board, because once they know about you, they're going to keep on coming back and being very nitpicky. So you want to be under the radar with them as much as you can. Did I see another hand up? Oh, okay. Robert, did that answer your question okay? Okay. Okay. Something else that I wanted to touch upon was beneficiary designations. The type of accounts and investments that you can designate a beneficiary are RSPs, RPPs, which are registered pension plans, tax-free savings accounts, life insurance products, segregated funds, and some employee share purchase plans will let you appoint a beneficiary. One thing you want to make sure of is that if you have, for example, more than one RSP in more than one place, that you don't forget to designate a beneficiary. I've seen a lot of people nowadays who are buying GICs and in registered accounts, and they're trying to get the best rates, so they're shopping around. They're ending up buying one GIC in one financial institution, one in another. They end up getting 10 statements a month, and they don't always remember to designate a beneficiary on each account. So it's important to do that as long as it's part of your overall estate plan. Sometimes it makes more sense to have the estate down, but you want to look at each individual one and make sure that they're taken care of.
You mentioned RIFs there, I presume that's part of it too.
Yes. These were just some examples. Yes, you're absolutely right. RIFs are definitely included in that. Yes. And as I mentioned, so you can choose either an individual. Actually, you can choose more than one individual. You can say two people's names, and then the account will be split 50-50, or the estate. So I was talking about estate administration tax before. If you do choose an individual as a beneficiary, there will be no estate administration tax. So that is one thing that drives a lot of people to designate beneficiaries on registered accounts. The other thing you want to keep in mind is to update your beneficiaries in the event of a marriage breakdown, or death of the beneficiary. That's a very important thing to do. The last thing you want is, for example, to have somebody pass away who had been divorced and remarried, who never changed the beneficiary designation to their new spouse. You really don't want something like that happening, so it's very important to think about things like that. Another thing that people do not always think about, and this is why it's very important to look at your overall portfolio when you designate beneficiaries, is that any account that is beneficiary designated is going to be paid out directly to the beneficiary. The money is going to go straight to them. It's not going to go into the estate. The executor will not ever get their hands on that money. Even CRA will not. The problem is if most of the accounts are beneficiary designated and there are taxes or expenses to be paid, and there's no money left in the estate, the money has to come from somewhere. And the last thing you want is to have to go to one of the beneficiaries and beg for money for them to give back some money to pay these taxes, for example. So it's important to look at the overall portfolio, see maybe there's some life insurance that would be available to pay the taxes, so it's not necessary to take this into account, but the most important thing is to check each one of them. And then the last thing I want to talk about are the impending changes to legislation. I touched on when I was answering Robert's question before. Sorry, I thought that, yes. And nothing's been carved in stone yet. Nothing has gone through, but these are things that people are talking about. A lot of this is being proposed by government to bring in more tax revenue, so there's a good chance that these will go through, but I cannot guarantee anything. So one thing is the Ontario State Administration Tax. There are possibly going to be new reporting requirements for assets of the estate and proposed penalties for not complying. So right now when somebody applies for probate, they only include assets that have to be probated. It's possible that in the future, the government of Ontario is going to request a list of all assets, whether or not they are included as part of the estate. And if they do not get correct information, if they realize that something is missing, not only will the executor be penalized, but it's very possible that anybody who gave the executor information will also be penalized. So that could include people like financial planners, brokers maybe who give statements, accountants. Lots of people could be affected by this if they do the wrong thing. So that's something to think about for people who volunteer or are asked to be executors of wills. This is something else that they're going to have to be really careful about. Another thing that might be going through, this was proposed in the 2013 budget. They're still talking about this. Nothing's been finalized again, is the taxation of testamentary trusts. I'd mentioned before that one of the benefits of having a testamentary trust is the savings on tax. And the government is proposing taking away this benefit of saving tax by putting money into a testamentary trust. So people who have them set up already, if this goes through, it could still be beneficial because of the other benefits, but people will have to take another look at the trusts. Anybody who's thinking of doing a will now with the testamentary trust, just in case, should have some type of a clause that allows for closing down the trust in an easy fashion if necessary. And the third impending change, which probably won't affect as many people, but the people it affects could lose out in a big way, is the dual will concept. Some people have more than one will done up to avoid probate fees on shares of private corporations they may have, and there's a possibility that there will be legislation introduced to eliminate the benefit of having this dual will structure. So it'll be interesting to see what happens in the end. It might depend on what government's in power, what the budget looks like, if there's a surplus deficit. We really can't predict any of this, but it's always good to know about it, I think, when setting up your estate plan. So I just wanted to finish with those in case people were interested. I think I see a hand up there.
I have two questions.
Sure.
First one on the trust issue. If that legislation passes, does that mean it makes more sense to reconsider gifting while you're alive as opposed to putting money in the trust and be taxed at the highest marginal tax rate? Second question is the implications of U.S. assets on your will.
Okay. So for the first question, I would have to say that it really depends on the situation with the person. I always tell clients when they come to me with
Stable human beings,
Yeah.
want people to go the money
Oh, yeah, no. What I was going to say is I always tell my clients that I need to see the full picture to give an educated response. So I have to make certain assumptions here. It is possible that gifting the money will make more sense, but it depends how that money is invested in the first place. For example, if it's all in cash and you're just going to write a check to a child, there's no tax consequences there. But if you have stocks that have a $100,000 gain, it might not make sense at the time. That's what I'm trying to get at there. So I hope that answers that question. If not, please let me know. The second question, I cannot answer questions about U.S. Taxes, but I'm wondering, is Brent questions? Well, I'm also available afterwards to answer any questions that anybody might have. And just a reminder about the kit that's available for you, the estate planning kit. Please take advantage. There's really good information in there. And thank you very much for coming out on this extremely cold evening. We really appreciate it.